Hi, this is Randy Finney with Right Side of the Chart, and today is Monday, June 24th, 2024. It's 11:40 a.m. Eastern Time as I'm starting the video, and what I'm going to do is this one will be dedicated to the markets. I won't do one of those all-inclusive videos. There's just too much to cover. Getting back to my getting back home from vacation this weekend. That is the longest vacation I've taken in years, and the longest period I've been away from, completely away from the markets, not trading, watching, only towards the end there, and I got a few posts out to you. This is when I started to re-engage things. But either way, let's dive into this. It's not going to be super long either. I could sit here and talk. I have a lot of pent-up analysis. I'm, charting and technical analysis and trading is in my blood. So I'm going to keep it pretty simple with just a handful of charts here. I'm going to start out with the most timely stuff in case if you're watching this video. I got some levels out to you this morning, screenshotted, static charts, I call them, on the major indexes and NVDA as well, which are really, I hate to oversimplify things, but if you want to keep it simple, that's really what you need to watch if you're going to trade the indexes are the, especially the big caps. You got QQQ or the NASDAQ 100, or if you trade the futures, same thing. And then the S&P 500 as well as NVIDIA. So those three things together, if you watch them and wait for, either pullbacks to support if you're bullish. Remember, when I give you my analysis, it cuts two ways. I'll show you, if I have an opinion, I'm going to tell you where I think things are going. If I don't have an opinion or it's not strong, I'll let you know that as well. And most importantly, where I think my skill set lies is, one of the things is really identifying key support and resistance levels that are valid and likely to, are tradable. In other words, if you are bullish and you buy pullbacks to support, it's TA 101, or you buy breakouts above resistance. That's it. Those are your, to keep it again very simple, the two objective times to go long. Either a breakout above resistance, and that may be top of a bullish chart pattern, a continuation pattern, or anything like that, or even a reversal pattern. Or again, if the support levels are broken, then you have one of two things to do. If you're bullish and long and you have a support level that you're watching, that can be used strategically to set a stop just below it. Likewise, a short seller or someone that's looking to go short will short. Like this is the last chart I got out to. This is the live chart, but I gave you when I was out in Italy. This minor trend line break, stating that would be your first objective short entry, which you got. We'll break down back test and short entry 1. Then the secondary trend line there, that one also broke. Then this is your next support level, and that broke today. And you can see, the charts are playing out perfectly so far to these levels. Each time you broke back tested, you got a pretty swift move down to the next one. Broke that one, kicked back. You also, after breaking, to hit that first support level I had there, 878.81, danced on it. Here, we'll zoom in. Danced on it for a while here, then broke it today, hit the next support level right there, bounced, and we're below that. So here's the takeaway. So we did get that next sell signal on QQQ. However, and I say this often, you shouldn't trade anything in a vacuum. I don't. You can do what you want. That is a breakdown. That is a sell signal. It's a solid break, solid 60-minute close. In fact, the next target was hit. We bounced. But the very same time, the S&P 500, which I'm going to get to here in a second, tested and held the comparable support level I gave you. So you can see it in the charts today. Right now, I'm looking at another monitor. ES, the S&P 500 futures are up 0.26% positive. The NASDAQ's down 0.37. So you're seeing that there. You got the breakdown here, but you're not going to go much further without the S&P breaking down. I'm going to get to that in a second. I just want to show you. So now you are at resistance, and you could say, well, that does provide an objective short entry. You can look at it that way. However, I'm going to show you here a couple other charts. This is NQ, the one I got out to you this morning, the NASDAQ futures. I'm going to pull it in a little tighter. And just like QQQ, as well as SPY, I have these primary trend lines that are the, what I call my preferred, near-term swing targets. All the levels are there for a reason. You're likely to get reactions upon the initial tag each one. So we took out that 19,937 target. There was a bearish rising wedge, breakdown, bounce off support, rode support for a while, then broke down. Let me zoom in a little tighter for you. And so I think we'll still zigzag our way down to here most likely. I'm going to also, in this video, give you some potential bull targets. I was playing around with Fibonacci extensions and Fibonacci retracement levels, and came up with what could be if these current divergences don't play out for anything more than a quick pullback that gets bought up. I have a target, and from where it was over the weekend, I looked, it's about 7% above a potential target. I'll get to that in a minute and talk about it a little bit. But as of now, this is my preferred scenario. That's why I have the arrows going down, meaning I think the most likely. But again, so there's NQ. We broke that first support. Next support here is at 19,769, or call that 19,770. But, and it's a big but, is the S&P 500. So again, QQQ, because they have a lot of the same components, will only go so far. And again, it's more about market participants, be they human or machines. You know, they're going to go in and buy. Some trade the SPY, some trade ES. You know, in other words, some trade the S&P 500, some trade the Nasdaq, some trade both. But when the S&P 500 traders come in and buy that support, that's the level I gave you this morning, 543.48. Buy, and they started rallying it off that level this morning where Nasdaq went down. There was a little, that's the dichotomy today. So there it is. So that's what I'm trying to get at here. Is the S&P has not broken that support level yet. If and when it does, it will, and I think it will. I think it will give way. That's going to be the next sell signal. It should be a pretty swift ride down to the next target. That's about 530. I labeled it 539.99, but everybody loves those round numbers, so we'll make it 540. And there's also a big old gap there, right there. So when that goes, there's your next target, and it should around that time, if that target's hit, you know, you zigzag down, it works like this, and then come in right around that primary uptrend line there, which is, so 537 in the primary uptrend line, come in about 1.2% below current levels. And then you can see I have additional targets here, and that would be a more powerful sell signal. And if you look at this, we have some pretty steep and big divergence. Remember, we had divergence back in, it was the last time we had 60-minute divergence here on the 60-minute chart, and it certainly played out for a little pullback. It was a very small divergence, hit the uptrend line, and now we went up, made a new but still an even bigger divergent high there in the S&P. So that's the level to watch there. ES are your S&P 500 futures. It's the same trend line here for the most part. Primary uptrend line, and that's also about that's a little bit better, about a 2.2% drop to that target. And again, that's an initial and what I call preferred near-term swing target. There's your rising wedge, there's your breakdown, but it's been holding, and just like SPY, it held that 55.20, 55.20.50 support this today. So that's the one that needs to go. Unless it does, the QQQ is only going to go so far. It won't go, in other words, QQQ is not going to drop much. And we also just hit my price target, the top of my target zone on the video. I'll get to that in a second. So there it is. In summary, we did not have, since this morning, since the open, the sell signals I was looking for. You need to see, you know, both SPY or ES and the NASDAQ 100 break down. And instead of doing that, they stepped in and bought support on the S&P. Again, based on the scope of this pattern, this bearish rising wedge right here, it's nice and clean, very clean, well-defined uptrend line with 1, 2, 3, 4, and then, you know, 5 reaction points there. The breakdown, pretty impulsive. It's most likely coming, in my opinion. But like I said, all I can tell you is support is support until less broken. So you want to buy that. The odds of a new high, they're there, but I still favor this happening. And just like last time you had a divergent high here on the 60-minute chart, you had that drop down here to this trend line. So there it is. SPY still at and holding above support. QQQ and NQ breaking the first support, rallying back to back test. Let me go back to it one more time. Where did it go? NQ right here, and zoom in nice and tight. We already did. We're right there. You can see current price level there. So this one's at resistance, And so we go down here. By the time we get down to that next target there, 19,770, we'll most likely see ES either at or breaking that support, and then that's going to open the door to this bigger drop here, which is about, let me try not to move my trend line. Yeah, that's better than you see. So you can clearly see here, based on my price targets, I expect the NASDAQ to outperform on the downside. That's about a 3.5% drop from where we're at now. And again, it's just an initial near-term target, one that will most likely bounce. Unless something bigger happens, and I'm going to get to that in 1 second, we could go on down through there. And if that does happen, we take out that trend line. Prefer to see a tradable bounce first off it, but then that would open the door to some deeper targets. Otherwise, if we never hit it, or we go up, make new highs from here, or hit it and then reverse, I'm going to give you some potential, what I call max upside targets right now in the market that would be just excellent if we get there. Excellent shorting ups. And we may or may not, based on the other things I'm going to show you. And NVDA, should have included that. I was trying to streamline what I get out to and keep it, focused on one thing. So I got you the indexes first this morning, then NVIDIA, and now we've hit that target zone. So NVIDIA on Thursday, in one of the updates I gave you on the very bottom, either right before it happened, we were poised to close. I said we'd get a bearish engulfing candle, and I think I got that post out to you right about the time, right before, after the close of the market in U.S. time here. I was 6 hours ahead over there. But that's it. So this is just a clean, beautiful uptrend line. Big, clear negative divergence. We haven't seen divergence like this on NVIDIA in a while. It's gone into complete, in my opinion, bubble mode. I've been around long enough to trade through the dot-com bubble and everything else. I look at a lot of metrics. I'm going to cover some of those today with you, but this one is just it's just gone crazy. The FOMO trade it's so thick you can cut it with a knife. Either way, there it is. We hit that first target zone I gave you today after the open. This one kept going down despite the S&P going up. We're still down 5%. We're on the top of it. Support or target zone is when I have a couple of it's actually a confluence of support. You have it's a very small band. It runs from about 116.80 up to 118.50. So you're talking a 1% zone. It's not very big, and we're at the bottom of it now with a very clean, well-defined uptrend line. This is what I call a high probability price target. Again, we already hit the top of it, but I suspect we'll probably go on and at least hit that trend line. And then I gave you additional targets, and then at that point we'll open up to the daily. I gave you this chart too now. And this is, I use a lot of different charting platforms. This is one of my go-to ones. And for the life of me, I can't understand why they can't get up with the times. Every time a stock splits, the lines don't get adjusted. So I have to manually redo the chart. So this is pretty, one aspect it's good. It's a clean board, a clean version. We still have the big divergence that's been building all the way since back here. Those were my divergence lines. When you get the splits, these don't change. Any trend lines you have on your indicators stay the same. It's only the price levels that change. And so really it's just one big massive, you can see here on the weekly, goes even better, divergent high. I have to update this weekly chart. And again, this is a clean, simple board. So there's that bearish engulfing. And I'm going to get ahead of this one now. I didn't read the comments. There were too many when I was gone. There was one thread that had, my God, so many comments. That was right after I left. So I'm catching up now. I'm reading the most recent comments. I'm getting back to any chart requests. But yeah, a few weeks back, on the markets, as well as all the way back here, I pointed out bearish engulfing candles in NVIDIA and in the markets that didn't pan out. At least we're not far off those levels, but they can't be topping sticks by definition. And what I'm referring to, bearish engulfing candles, just like a bullish engulfing candle in reverse. Bullish engulfings are potential bottoming sticks. Bearish engulfings are potential topping sticks. You want to look for them after an extended and prolonged uptrend. Again, because they can come in the middle of a trend. They don't mean much. That had the potential to be a top, but it obviously wasn't. So here's the thing. Here's the way I work. It doesn't change anything just because the last ones didn't work out. I've been doing this for decades, technical analysis, and quite often, just like the October lows were bullish engulfing candles in the markets, that proved to end the bear market in 2021. 2022, and I've seen plenty over doing this for a long time. I've seen plenty of bullish and bearish engulfings that did mark the end of a trend, either the end of a downtrend or the end of a top. And you've heard me say this many times. There is no one indicator that's 100%. If there was, none of us would be working. Everybody would use that indicator. They would set their computer to automatically find it and then go all in, or that you'd manually do it. So all I can tell you is, there's probabilities and what to look for, and then also how to trade them. And that's the thing about it. So when you get these bearish engulfings, I couldn't be too wordy when I was, on vacation last week, but it's a given. I've covered the strategy many times. You get a bearish engulfing if you've got other reasons that you can support a case for potential reversal. And this one, low short interest, extreme bullish sentiment, extreme overbought conditions, negative divergence, everything in the book to make a case to be short. The only thing not to, and to me it's never a reason, is the momentum. Yeah, catch tops and bottoms. Yeah, sometimes those tops and bottoms don't come, but again, it's about managing risk. So when you see a bearish engulfing, this is a strategy I've shared many times, including in recent weeks or months. It's very simple. You take a short position, you put a stop right over the top of that candle, because if you move back above it, then it's no longer a topping stick. It's a bearish engulfing candle, but it's not a potential reversal stick, because then you made a new high. So your downside is so minimal. So if you took that short last week, you had about not even an 8% loss potential. And so far, again, waiting till the candle was printed, or if you took the breakdown, that 60-minute chart also broke down that day, would have got you in as well. And I'm not playing the game from the top of the candle, because you wouldn't have known then. Just from the bottom, you made already 9.5%. And looking at the daily chart, I don't see anything support-wise. Again, I had 60-minute, and I'm going to put it right here. I'm going to put a line. I'm not just forcing this line. I put that line there. It's probably the bottom of my support zone on the 60 I gave you. You have multiple reactions there. A little breakout candle, back tested that level, and it comes in here. So there's a little, I see what appears to be most likely at least a little more downside there. And then very much so, because it is a bearish engulfing, again, a potential topping stick, the potential to see a move down, which I've been calling for a while, and I will not stop calling for. I almost can guarantee it's going to happen. NVDA will come and visit its primary trend line off this right here, off the October low. Actually, yeah, that's off the October lows. On the weekly, I have even a longer term uptrend line. But this is just a kind of call it an ideal or a high probability swing target, and it comes in with that 96.23 support. So if you're willing to hold your nose and jump in the water, take the plunge, again, if you especially, it'd be much, but I can tell you right now, it's not an objective entry when you're at my first, just hit the top of the support zone. But if you did take the bearish engulfing candle short, and you want to, either keep your stops there for now or lower them. So far, we have confirmation with 2 additional red sticks. That's also something I always say you want to see, is follow-up to the downside helps increase the odds that bearish engulfing is going to stick. What happened here, you went down one day, and then boom, you came back up the next day. You never even violated that second day candle, tested it there. You did go down. Let's not, it was a pretty good drop. Let's just quantify it here. It was about a 23% drop, but eventually you can see what happens in technical analysis. When they popped it there, they popped all the stops. If anybody put a stop over that candle, even wrote it out there down to the bottom, then boom, that's where they should have and did stop out. And this was just a stop clearing raid, in my opinion. Same with the markets. But there it is, guys. So just to go back to where we were, if you hold out for the prize, if we get to the prize, it's going to be about a 30% drop there, that uptrend line. And for you NVIDIA bulls, look, again, support levels are objective levels to go long. So you can go long here, where we hit the lows today, the top of my target zone, the bottom of it, the trend line. Those are all objective long entries. If you're looking for a deeper pullback, then this 96.23 plus intersecting uptrend line support, if you want to get on board the NVIDIA train and you think there's more downside to come. And again, I made mention, when I put this out there, just recently it overtook Microsoft as the largest company, public traded company in the world, biggest in the NASDAQ 100, S&P 500. So you've got that mathematical weighting, and nobody can argue the psychological impact of this one right now on the stock market. So there's your update. And again, I trade them all in tandem. And so in summary, you've got the S&P 500 opening today around support, holding above that support. You have NVDA hitting support just right after I got that post out to you, and you can see the low of the day was 118.29 versus my top of my zone at 118.46. So close enough. But you have my thoughts and where we're going. If we do bounce, the way it works is in reverse. Support once broken then becomes resistance. You may also get a trend line going here soon. And that's that. The other one I just wanted to update, because this is one of the few long-term core positions. This is one I still maintain a target on, a position in. SMCI going down to 355.60. That was posted, shorted it here on that breakdown there. It's moving sideways, but it's not making new highs like NVIDIA, and this is just a massive support level. I think that's why I have it in yellow, 690.46. So you can call it a proxy trade on NVIDIA, and it's also still profitable as a short, just going sideways, but it shows this one looks very toppy to me, and the whole sector is a like I said, undoubtedly a bubble. AI is here to stay. It's just another iteration of technology that's been around forever. It's just become it's kind of a buzzing. It's just like the dot-com bubble back in the day. And those companies, the internet was certainly here to stay. It was new, but it came at some point to something bigger than it really was, and it was a reason. And then it built on itself. That's how bubbles work. Everybody gets the fear of missing out. Buying begets more buying, and et cetera, et cetera, et cetera. And then when the trade turns, it gets ugly. Okay, the other stuff now. Short interest. Short interest. This is the crux of the whatever you want to call it. Bubble, FOMO trade, strongest index. Again, we all know, and I'm going to get to this again, that there's first of all, everyone knows, and it's been well announced if you listen to anybody that knows markets, there's a whole disconnect between the economy and the stock market. They're not the same thing. One can be going up, the other can be going down, but we're not going to do that today. We're not going to get into fundamentals. So everyone has their own thoughts and opinion on market and economic indicators, which ones are really accurate, not accurate. Doesn't matter right now. We're looking at pure technicals. But what I can show you definitively, we dropped down at the end of May. Now I'm going to get to that in a second. That's a long time ago. We're almost at the end of June. 47 million shares short by far, and we're going to scroll down here. The lowest in the past year. This one only goes back a year. You can see a year ago it was 75 million. You can see in the 70s, upper 60s, short interest has plummeted off. Now, the problem with short interest, at least for us lay people, if you will, I don't know if the big firms, I'm sure they have, ways to get it, a more accurate number. I have to extrapolate. I've done this for years. For whatever reason, as much as technology has advanced in the decades I've been tracking short interest, they still have this antiquated bi-monthly dissemination schedule. So in other words, they take the short interest, here's your settlement date. So there's May, the end of May. All the brokerage firms have to then report it by a few days later, 4 days later, on June 4th, right? And then they disseminate it after that. It takes about another week. Again, why? When computers hash this, nobody's sitting there with the little ching-ching machine, the little accountant with his glasses and pen and an adding machine. So I don't understand why they wait so long to report it. Maybe it's to give the big firms, they pay to have this information dated. It doesn't matter. That's just the way it is. And so here we are, we're already at the end of June. We're not going to get that number until July 10th, but we do have the mid-June numbers coming up here in 2 days on the 26th, and it's after the market closes, so it's really, you can't act on it until the 27th, almost the end of the month. Again, whatever. Now, So where I'm going with this is, so let's just keep in mind the latest data comes at the end of May. And this is where, you just have to extrapolate and trading long enough to look at a chart, to listen to, comments both on TV, this website, everywhere else, to know that this is a, capitulation of short sellers. Just a kind of that final short sellers giving up, squeezing out. So I wanted to point out is there's the end of May where the crosshairs are right here. So this candle right here was that last report. So if you had to venture a guess, and that's all we can do, but I think it's an educated guess, from here to here, do you think short interest increased or decreased? I would tell you most likely it decreased. There was a lot of shorts being blown out, especially once the market broke out above that previous high. So now we're looking at what I call potentially we'll get the numbers. We're not going to get the end of month numbers. We're only going to get these numbers here. So I'm extrapolating 2 reporting periods ahead and telling you that in short interest is probably at what I would refer to as, for lack of a better word, dangerously low levels. Now, dangerous for who you are depends for longs, because I've said this often. The way this works, it's a contrary indicator. Number one, shows that everybody's bullish, nobody's bearish, and those are when short. Again, I'm speaking generally. Short interest is at extreme lows, not in the middle of those numbers, not 60,000 shares, 55,000. You want to see an extreme, so that's obvious right there. And then more importantly, as I often say, any stock or index, think AMC, GameStop, that's how those meme stocks, they blew it up. When you have a company or an index with a very high short interest, there's a potential for short squeezes, which number one, that may have been, probably was. And also, everybody, you get most shorts, the short sellers only guaranteed buyers. They have to cover at some point. So ideally, you want to be in a perfect world shorting stocks or an index that have very low short interest, because when they start to fall, if you don't have a lot of short sellers already in the stock, they're not covering on the way down. When you have a highly shorted, when the NASDAQ 100 is highly shorted, you get the pullbacks get bought up as short sellers take profits. I'm an active trader, I'm scalping these little, sometimes 3% moves, sometimes even less if I'm trading the intraday charts. I might look for 1% swings in the NASDAQ and show you those little short-term active trader setup. So that's my point, is that we could, because of the low short interest and the other thing I'm about to get to here, we could just blast right on through there and have very little reactions off these levels. So I just want to say I'm open to that. I'm open to anything. If a trader, you have to be. I'm going to show you again the potential if this keeps going up, where we might go to in just a second. But I wanted to point out the short interest, and if that is the case, if you're long, be careful. If you're a bull right now and you're looking for an objective entry, I would say swing it down. If you're short also and you're looking for an objective level to cover, right there. You can see on my QQQ daily, it's about 460.50, 50. And that is about almost 4% below current levels. You also had a bearish engulfing, of course, in the NASDAQ 100. Remember, right now, NVDA is almost the NASDAQ 100 and S&P 500 again. If I had to, you could blindfold me. You could probably successfully for the next several months or in the remainder of the year trade the indexes by just watching the chart in NVIDIA. If it breaks key support, short the indexes. It's going to have, again, not just a mathematical weighting, but a psychological importance that will probably spill over into the other stocks. All right, so that's that. And then look, if we go on down through there, then I'll talk about some additional targets at the time. I'm going to put a level here. It's been a while since I've marked this chart up. There you go, right there. Okay, before I left town, and I think even one time after, when I was on vacation, I got out to that I had a few very, very rarely seen sell signals fire on this. Again, it's my variation of the Hindenburg omen. I didn't create it. It's been around. It used to have a pretty decent track record. And again, it's just something. It's not a standalone thing. It's not a timing indicator. in that post I gave you last week or so, a week before, a link to read about it on Wikipedia. And what it says in there, if you read it, is that, the more signals you get in relatively close proximity, meaning over a period of weeks or a couple months, the more accurate it's going to be. So it's not, sometimes one and done, and sometimes you may get a signal. But if you go back in time, which I have done, the way to do it, if you're trying to analyze it, I'm gonna zoom in here a little bit, but I just want to show you before I zoom in. We did have some signals fire. Remember, this is when the NASDAQ peaked back in November of 2021, and we did have at that time, I believe, right before it was one of, if not the last time it fired. It fired off then, and I think you might have even gotten one off right before the COVID drop there. So again, they're very rare. And one way to just eyeball here, let me drop down. I know you can't. It's hard to see this in the video. There's so much on this chart. I can't really do much about that, and including all the conditions were there on the other one. You have to have the NASDAQ McClellan oscillator red, negative. You have to have the new highs to the new highs to ratio, number of new highs compared to the total, above 2.8% on both, and that's what's rare. So you got to check each box, and then you have to have the new highs to new low ratio under whatever that number was there, 2, I believe, 2.0. So you can see the criteria on my other chart, and I gave that to you right here. So there's all your criterias and our criteria. And let's go back to a 3-year, just so you can see a little clearer here. Or we'll even step it down to more recent. Well, I'll do this 3-year just to kind of show you how infrequent the signal is and how to analyze it if you're going to replicate the chart. First of all, you got to have this. I start here, and you got to see, one of these two above that line. It's set at 2.8% right there, those two lines. So you can quickly go, okay, you got a lot of green here above the line, but all the reds are below. In other words, the new lows. And so you go across, and you're going to see when you have a lot of new highs, that's a healthy market. When the market's making, going up, making you should have more stocks making new highs, and then when it's going down, more making new lows. But what happened again? It's a form. Basically, it's a breadth indicator. It's using different breadth indicators, and it tells you there's something wonky right here. You had several of those fire. This has to be below the line, which it was. So in the NA, the McClellan oscillator was red. We were trading above where we were 50 days ago. So we had multiple signals fire recently. And again, you can go back in time and you're not going to see that a lot. You can see we were correcting there. So you had a lot of new lows, but there weren't any new highs. That's normal in a market. So again, it's the same story I and some others have been talking on. It's a extremely bifurcated market with the big, the big mega tech stocks doing almost all of the lifting. And it's happened for a while, and I always say that's a condition. That's not a sell signal. Yes, I've been talking about for a while. Yes, others have. It's not a sell signal. All we can do is time our entries and exits off the breakdowns, and wait for objective trade entries. But I could tell you when we reach this extreme, I've been talking about the other breadth metrics out there, but they weren't at extremes. This is a rarely seen thing when you get extremes. The other thing that I covered recently was, I have to go to my, it's a breadth indicator. So I go to sentiment indicators, and I look at the, there it is, where are we going here? Okay, the put to call, the total put to call ratio. I got this one out to you right before we left. Let me resize this chart. Okay, I have some different variations of this chart, but I've been using this one for years, sharing it here on the site. I haven't posted it in quite some time, especially this one in particular, CPC, the total put to call ratio, because there haven't been any signals in a while. So you can see here I have a dashed line right there, a green line dotted. This little shaded area should be moved down a little bit. But when you get here, that's excessive fear, especially when you get up into this zone here. This is when it means the put to call ratio is spiking, meaning a lot more people buying puts than calls. And if you look, this is it fired right when at the COVID lows. That was it's going to go down in history. It's probably one of the best buying opportunities in generations right there. You can see what followed. We had one right here. Remember, we had the bear market, or at least the initial leg down. Nasdaq peaking. Here's the S&P I have here. The S&P, remember, peaked right at the very start of 2022, where the Nasdaq peaked a little earlier, and S&P fell 27%. The Nasdaq 38, and you can see it's fired right here. It gave you a get-in moment because everybody was buying puts. And then again, we have, this is the biggest correction since, and it fired right before there. So it's pretty damn good timing indicator. What you'll notice here, sometimes you look for these clusters. Sometimes it's called a double tap, what I call it. This was a double-digit drop. There was COVID. You can see all the drops, and you can see my arrows too. It's not a exact timing indicator. There's usually a little bit of a lag because you need to reach that extreme sentiment. So where I've always had the line was right here for years. I've added this one recently because that did do the trick the last time, right before the market top, and that's exactly right when in November, right when the Nasdaq peaked and followed by a 38% drop. That was the last time we fell to this level. Not even close, you can see there. So I wanted to I pointed that out right before I left town for vacation, or no, during vacation, I think it was. Either way, that's that. And so that's really the level. Now you might see, we came down here and we're there. That was a cluster reading, but that came after a 36%. That was the worst bear market in decades, right? One of the worst since the financial crisis, 36% drop. And I believe it was, I think I'm measuring the S&P. I think it was even more for the Nasdaq. I forget right now. Either way, so you don't look for a sell signal after a bear market. That already happened. You got the sell signal was right there. Boom, you hit it, and it fired right before COVID. So again, you can say COVID was a random thing, a black swan, but there were so many technicals, including this one covered at the time, that triggered that sell signal right before that drop. So I just want to tell you, it's got a pretty darn good track record. Now, the thing is, sometimes you get a double tap or there's a time where it didn't work. And again, I try to always impress that nothing's 100%, but when you have, probably go through this, I don't know the number, 80% success rate on buying, nailing or identifying the lows, within close enough proximity that if you just use a signal alone, and you hold out, you're going to usually get paid off. So again, well over 50%. So I wanted to point that out. Now I do have other ones. I have this equity only put to call ratio. That one has not fired. That one's been pretty reliable too in the past. That's not it. CPC right here, the equity only put to call ratio. You can see this is the buy level. I've had this line here for years, and you can see it triggered a flurry of buys there. That was when the bear market ended. Then we had this extreme fear here. Fear with it spiking, and it came in a cluster there. But right now we're in no man's land. We're kind of in between there. So I'm watching this one too. And if that falls, and if it does, probably going to coincide when I give you these potential upside targets with the Fibonacci levels that I'm using. Okay, next one up. This is one I've shared many times in the past. I've also been using this for many years. Over the years, these levels will change. The levels I'm talking about, I call it my low volume indicator, and it's pretty simple. It's just something I came up with years ago, playing around with the numbers. I put a 10-day exponential moving average, that's this blue line, on volume. The reason I do that is sometimes if you're using just any single day volume, you get holidays with abbreviated trading sessions or whatever, and so it's going to give you some false signals there. And so when you look at a 10-day moving average of the volume, it shows you volume's been plummeting off, and it's been pretty, also again, not 100%, but pretty damn effective. So you can see, going back here, I have a red and a yellow line. Sometimes the red line does a trick. Right here you can see red line down on the bottom and a yellow line, right? So Let's just take it back as far as this chart I've rolled here. This is 2018. Remember the big Q4? If you've been trading a while, there was a big drop, and we milked every penny of it from the highs down to lows, reversed it, went long. That was the Q4 drop in 2018. It was 20-something percent and 25% at least in the NASDAQ 100. And so you can see right before there triggered, we hit the red line right before the drop. So volume had been falling off. I can't scroll back any farther, guys, but that's where it fell to the level right there where my crosshairs are, exactly at the high. And it fired that sell signal, and that came. Now, there were other reasons we shorted it. Divergences, trendline breaks, bearish chart patterns, and some other things, and watching all the market leaders. Now, when you get just like that put to call ratio, once you have a correction, you got the big correction. Again, there were reasons to be long there. Then it's not as important. You don't. So when you're using these type of sell signals or the put to call ratios, once you've gotten the bear market or the sell, then it's you're not looking for. Next thing you're looking for, you look for a bottom. You're not looking for another repeat of that, because then volume stayed low. That was the new norm during this rally, but it was persistently low. And then you can see an extreme right there where it plunged below the yellow line, the bottom of that. And that was just before the COVID lows right there. So again, you can see the takeaway here is when the stock market is rising on declining volume, that is a red flag. It always has been. That's one of the earliest tools in technical analysis is trying to, you're looking at a move in a stock or the markets, and you want volume to confirm that move and at least not refute it. So when volume's plummeting off, it shows you who's buying. It's just the market's drifting on autopilot. Shorts are giving up. It's going up because it's not facing the headwinds. It's Newton's law of motion. A body stays in motion unless acted upon by an equal but opposite force. So, and that's selling. So you can see it hit it there. Then we were good for a while. We had that big drop when COVID came. 36% in the S&P, and then you can see we did trigger. We had some signals there. Didn't really do much, but yeah, it did. We stayed at that level until this point right here, and we did have. That was a double-digit drop there. We almost touched the line there. Close, yeah, we did. It was close enough, pretty much right on that red line, and that came just, a couple month or two early before the top. And so again, it was this drop down to that level. As you can see there, volume never even came close since the bear market, from the November 2021 highs to the October of 2022 lows. Really right there. That's an intraday move. It's basically a double low. That was it. That was the last time we fell to this level. And this is what I wanted to point out. There we are. So I just showed you some of my more reliable indicators, and they're firing in conjunction right now, setting up the potential for a much bigger drop. A stronger case I can make right now than I've been making for a while. Just want to say that. So now we watch the levels, and let me finish with the last chart I wanted to show you. Let me pause the video because this one's going to be a little clunky and I have to cue it up properly. Okay, here it is with QQQ. So this weekend I was playing around with the charts. I noticed this is one board. I have a lot of different boards, I call them. These are boards. You can save different annotations. But on just about everything, I have a key level right here. Very, very significant support level. Very likely pullback target. If you're bullish or if you're short, you want to cover a bounce there, go long. Either way, we had multiple highs there. The market was hitting this high, couldn't break out, got rejected. Finally, we had a breakout, a back test, and this last thrust to new highs, right? Okay, so it's a very, very significant support level. And then I also had this one here. We had a major reaction high here, followed by a pullback, then a big green breakout candle. It may be hard to see on the chart. I'll zoom in a little bit. And for additional validation, there's your reaction high, there's your breakout candle, and then we back tested it here, and that helps to validate that so these are key levels. And then this is a huge one here. Back in 2023, the market peaked here in July, had the biggest correction since it bottomed, and then came up, broke out above that level, successfully back tested. So those are the three single most important support levels on the NASDAQ 100, in my opinion. And so what I noticed in playing with the numbers here is I took Fibonacci, I was playing around with the fibs, And I usually I've never done it this way. I pulled a number off the bottom. I was looking at where we are at now. So these are your fib lines. So what I did is I was pulling the fibs up, and I noticed that it's the white lines. Let me try to turn off. I've got so many on here. Let's see what I can turn off for you. Let me try something else here on a clean board. One sec. Okay, I had to clean up one of the boards. I'm going to put up fibs now. So I'm going to grab my Fibonacci tool. We're going to come back to the October of 2022 lows. That's right here, that big green ginormous bullish engulfing candle, which certainly marked the bottom of the the move off the 2021 highs. And so, you know, I was putting my fibs up, looking at fibs, and let's just say the bearish engulfing candles on QQQ and NVDA last week were the top. My fibs, I have one lines up here, the 23.6%, that's your first fib, comes in right exactly with that 433-ish support level right there. But the rest don't line up, so I just played around for kicks and giggles and pulled this up. And now you can see, hopefully you can see it here. You can see, again, look to the left of the chart. There's the fib levels. This program won't let me move them to the right, another quirk, minor quirk. But 23, 38.2, 50, and 61.8. If you don't know what Fibonacci retracement levels are, please Google search it. They're very useful tools. I incorporate it into my trading. And the way I always use them is I'll always identify, first and foremost to me, are price and support and resistance levels. So I identify those on my charts, trend lines, then I add on the fibs. And it never fails to amaze me when I've called the top or the bottom correctly, that how well the lines, the fibs tend to line up with the support and resistance levels that I previously put on my chart. So this time it didn't. So what I did here, I'm taking the line up. That's where we are, assuming we top. And yeah, we got a 23.6 retracement. We'd come down to 433 right there, which is price support. However, if I pull these lines up, now I line that 23.6 up with this major this level right here. Again, it's about 448. We'll call it 449. Again, that was the highs, biggest correction in a while. Breakout back test, what I just covered on the other chart. I'm going to come in a little closer so you can see it. That would be it lines up perfectly with a very well-defined price support and a 23.6% retracement. Typical run-of-the-mill pullback. The next level, the other key 38.2, lines up perfectly with that 413-ish level right there, which again was this major reaction high, pulled back, couldn't break out, another rejection there. Big green breakout candle, perfect back test, and off to the races, and that lines up perfectly with 38.2. And then the 50% comes in almost perfectly with this. You had these highs right here, a gap up here, breakout, back test, a lot of just, again, a very well-defined technical level. And that lines up almost perfectly with the 50% Fibonacci retracement level there. You even have the 61.8 all the way down here on these reaction lows. So now, again, I haven't done it this way before. You know, usually when in an uptrend, you use a Fibonacci projection tool to identify targets. I'll show you how that works in a second. But that brings you up here, and the level is it's to make those line up perfectly is at 509.40. So here's the takeaway, guys. This is I'm flexible. I'm open to anything. We're in a strong uptrend now. I've just spent most of the video showing you the bearish case, at least for a near-term pullback correction, some targets, what needs to happen to get there, of course. People don't listen to that. And, if S&P doesn't break support, we're not going to go any lower. Even if the NASDAQ goes a little bit lower, it's only going to go so low without the S&P breaking down. It's just that. So from the recent highs, which would be Thursday's bearish engulfing candle, that's only another 4.5% higher. And then from right now today where we are, because we've already had a little pullback in QQQ, it's 6% higher in the NASDAQ. So that is, again, from that point, if we went up like this and then went up to here and then corrected, and we can do that at the rate the market's been moving, that we could do that in a week, right? A good week, right? There's a 10% rally right there. And so the upside, in other words, is pretty limited. Now, look, if we get there, obviously I'd want to see, other than just this, a reason to, get short. And if I have based on how perfectly these fibs line up, and I did it with the S&P, I used some projection lines, I would be aggressively short there if I had additional evidence such as trend line breaks, divergences, overbought conditions, breakdowns in any or all of the big leading stocks, particularly NVDA and things like that. So again, that quantifies it, gives you a price target right up there. I'm going to put the line up there so you can see it. And 509 right there, which again is just another 6% or so from where we're at now, and only about 4 point something from where we were, 4.5 or so last week. Okay, and just to show you the S&P 500, same thing. Put the fibs right here on the October of 2021 lows. Extend the fibs, not from where we are, but a little bit higher, which again, a little bit would be, let me tighten it up for you. From Thursday's highs, you're talking a little less than 6%. From where we're at today, yeah, still about 6.5%. And that level on SPY would be, it's about 580 right there, okay? So if we happen to move up there, it wouldn't be ideal because we might burn through these divergences. We still have that negative divergence. Yes, guys, negative divergence. I know, another divergent high. Yeah, that was a divergent high. That was the last big tradable drop. We traded it down. We covered the lows, reversed. And now we have even a bigger divergent high. So it's ideal, not necessary for a major top or a turn to see negative divergence. So we'll see what happens. But again, I want to point out that you can see, I think you can see, if you can't, how well the fibs line up. These were the levels I had, price levels, already had on SPY. 524 right there. There's actually two levels there. The yellow line right here are the Fibonacci retracements, saying that if we got up to 580 and we corrected, it lines up perfectly with the 23.6% fib retracement line. Here's the 38.2, which lines up perfectly with this major support level I have at 494. It's that reaction low. There was a breakout, a back test there. And then I have a zone here, really. There was this previous high right there. And I also have a nice support level there. That lines up almost perfectly with the 50% the Fibonacci retracement. Again, assuming we get to that point, then those price levels. Now, the price levels on their own stand. They don't have to line up. I just found it pretty compelling how well both the S&P 500 and the NASDAQ 100 line up. Those key levels that I already had line up if and when we can have another 5-6% up in this market. And again, so we'll look for sell signals if and when we get there. And if we don't get there, maybe these divergences play out now. Maybe the sell signals, bearish engulfing candles. You can see on here I have this is the purple line here. Right here are Fibonacci projections. You just, to draw that, you put that at the low. This is the first major correction we had in the bull move off the October 22 lows, I'm sorry. Big correction there. So you add you drag it like this. You see your line, the dotted line, you put that down on the correction, and then the purple lines project. And so they give you the Fibonacci projections, which show you right here, that was 100%. The next one would be up higher, right above. There's a 161.8 Fibonacci projection line. I know it's hard to see in the video. It's purple. It's right above that level. So it's about 580 to 590 is the the projection, if you will, because we've already passed the 100% fib projection right there recently. And either way, all right. So those are some potential levels to watch. And that's about it, guys. In summary, I'll go back to where we started the video. These are I might talking about the downside potential levels that need to happen, and this is the first one. So it's very simple stuff. We don't break 543.50 on SPY. We're not going any lower. Maybe we do see that 5, 6, 7% lift in the markets. We break that. It's going to increase the odds of my preferred and still favored scenario that we go down to test these trend lines, in which case, if the charts confirm at the time to go reverse, cover shorts, and go long, that's what I'll be doing. Otherwise, I just spent a lot of time in this video showing you some rarely seen indicators, such as the Hindenburg, such as the put-to-call ratio, that could be the catalyst for a move that, again, the biggest moves come when almost nobody expects them, and you could see just a big, smashing down through those levels. If it's wishy-washy analysis to you, I don't know what to tell you. If you want to know how to trade it, well, you have to formulate what you believe and what you think may happen. One way to do it, if you want to go for the prize, is, if if you're short, you shorted the bearish engulfings, or you're going to short 543 break on SPY or the next level on QQQ, you can, just periodically ratchet your stops down or trail them down. I don't have to tell you, I shouldn't have to tell you, but in this market, a tight stop of 1-2%, you might as well just hand them your shares right away. You're going to have these little, zigs and zags. So, it's a pretty simple strategy. If you want to use the simplest strategy, you look at Thursday's bearish engulfing candles. We even had one in SPY as well right there and engulfed that previous candle. So there's your stops right there. Didn't work out this last time. There's the last bearish engulfing I pointed out right there. And we took it out. So you would have been stopped out. And now you can try it again. And the way this game works is you put the odds in your favor. It's like doing any other thing in life. Stack the odds in your favor, and if they are in your favor, then more often than not, you're going to win or be successful. And there's going to be times you're not. That's the thing. If things that have a probability of 100%, you don't need to be told what to do. It's a given. All right, so that's it. There's a little trend line I just added on SPY as well. I don't know if I had that on the 60-minute chart. Oh, yeah, I did. That's the one that we're targeting right there. Oh, no, that's a little different, the way I drew this one. Huh. Like I said, guys, I've been away from the charts, and I'm marking them up, and I'll continue to do so. This is just a different board. It's not my main board on SPY. There's my main board on SPY right there. That's actually how I had the trend line right there. So we're already broken down below that trend line on the daily after the bearish engulfing candle, and you can see this is the primary trend line in yellow right there, and that meshes with what I had on the 60-minute chart, about another 2% or so lower. Hit that. If you're bullish, certainly an objective place to go long, and if you're bearish, you either want to wait for a break below it to add to or initiate a short position, and then you swing for the deeper targets. You still have the 200 days, which we're going to come and visit. It's just a matter. It's a certainty in the markets. You go back long enough in time, and you can see my 200 days right here. The market will come to visit the 200 days in a bull trend, and that's what you want to do. You buy pullbacks to the 200 days in a bull trend like you did here, and you're short once they break, and you cover. There's a short. They don't look like much, but these were the big drops. That was COVID. You took out the 200 days. That was the Q4 2018 drop. You were under the 200 days. There we broke the 200 days back then in late 2021. You stayed below them. They were objective shorting entries every time we came back to them, and then finally you broke above them, and then you successfully back tested. And as I pointed out here, you hit them again. It did very, very simple stuff. A lot of people know about and watch them, have computers programmed to buy them, and it's just almost an immutable certainty that you get far enough away, you're going to come back either all the way to them or close enough. That's just how it works. You get, even in an uptrend, nothing goes straight up. You come back. It's hard to say whether we visit them very soon and or months from now, but if and when they're broken, that's going to be a more powerful sell signal like it was back here. So all right, I'm going to wrap it up here, get the video out to you, and I will follow up. I know there's requests for things like wheat and natural gas and crude oil, gold, silver, palladium, best looking metal out there right now. At least was coming off a divergent low. I found that over the weekend. I'll try to get to all that stuff, guys. Again, there's just a lot. I'm still catching up, and I'm trying to get things out cohesively to you. So this was your update on the equity markets. And the next one will be commodities, precious metals, whatever else I can get to. This has been Randy Finney with Right Side of the Chart. Have a great